Hey everyone, welcome back to Corporate Decoded, the place where we uncover the hidden stories in your favorite company's latest SEC reports. And trust me, this one has a few surprises up its sleeve for you, alright. So we're re-diving into a thick SEC filing today from Macquarie Group covering two of their funds, Macquarie Corporate Bond Fund and Macquarie. Extended Duration Bond Fund. These reports are basically annual checkups for these funds, telling us how they performed, how much they cost investors, and what they actually own. It might sound dry, but there is often a financial narrative hidden here, a story about where the money went and, more importantly, if it made money or lost money for ordinary investors. These funds, imagine you put $10,000 into Class A shares of the Macquarie Corporate Bond Fund. For the last 12 months, your cost would have been around $82, which is about 0.80% of your investment. Not too bad. But then we look at Class C shares for the same fund, and for that same $10,000, you would have paid $158, which is 1.55%. Now, that difference might seem small, but over time, and especially for larger investments, it adds up. This is a great example of how different share classes can have vastly different impacts on your returns, even within the same fund. Now let's fast forward to the financial performance for the year ending the 31st of July 2025. The Macquarie Extended Duration Bond Fund class shares actually saw a negative return of about 3.27%, including the sales charge. This is a pretty significant drop, especially when you compare it to their benchmark index, the Bloomberg US Aggregate Index, which during the same period returned a positive 3.38%. That means the fund not only lagged its main benchmark, but it actually lost money for its investors in this class, while the index grew. This is the kind of number that makes you want to dig deeper into what went wrong with their strategy. Let's take a quick peek at the financial position as of the 31st of July 2025 for the Macquarie Corporate Bond Fund. They had total assets over $1 billion, which sounds massive. But remember, over $1 billion of that was actually tied up in investments. This means that while the fund is large, its core business is clearly holding and managing these investment assets. Then there are the liabilities, not as big as the assets, of course, but worth noting: payable for securities purchased and payable for fund shares redeemed are the big ones here. This essentially shows what the fund owes to others, things like money owed for securities it bought or money it needs to give back to investors who sold their shares. Now let's talk about what each investor actually owns, the net asset value. Per share for the Macquarie Corporate Bond Fund Class A as of the 31st of July 2025 stood at $15.27. That sounds straightforward. But remember, this is after all the costs and fees have been taken out. This is the true value of your slice of the fund at that specific moment in time. And for Class C share, it was just a hair higher at $15.28, and for institutional class it was the same $15.27. It is fascinating how these share classes with different fee structures end up with very similar net asset values per share on the same day. Let's look at the financial highlights for the Macquarie Corporate Bond Fund Class A over the past 5 years for 2025, the net asset value. Per share was $15.27, which is a slight dip from $15.39. The previous year it is not huge, but it shows a small decline. And when you look at the total return for this class, it was 4.10% for the year ending the 31st of July 2025, but going back 5 years, the total return is negative 0.90%. That is a trend you need to pay attention to, losing money on average over a 5-year period is a red flag for any investment that is supposed to be growing. And for Class C shares of the same fund, things are even more interesting. The net asset value per share at $15.28 for 2025 is again a slight dip from the prior year, but the total return for the year ending the 31st of July 2025 was 3.33%, still positive, but lower than Class A shares. And again, not stellar, and the 5-year total return for Class C is a negative 1.62%. That is a significant underperformance, especially when you consider the fees associated with Class C shares typically being higher than Class A or institutional shares. Now let us shift gears to the Macquarie Extended Duration Bond Fund class, a shares the net asset value. Per share is $13.94 for 2025, which is down from $14.42 the previous year, a noticeable drop there. And the total return for the year ending the 31st of July 2025 is a negative 3.27%, including the sales charge. That is exactly what we saw earlier with their benchmark index doing better. This fund is really struggling to keep up, and this negative return is a serious concern. What is more, the 5-year total return is a dismal negative 4.90%. That means if you invested $10,000 5 years ago, you would have lost on average almost 5% each year the fund. A strategy here for extended duration bonds seems to be really hurting investors in this class. Let us switch gears one more time to the Macquarie Floating Rate Fund class, a shares here, the net asset value. Per share is $7.95, which is down slightly from $7.98 last year, but their total return for the year ending the 31st of July 2025 is a much healthier 7.33%, excluding the sales charge. That is a whole different story compared to the other fund. We V-looked at, and when you see that benchmark is the Morningstar LS State US Leveraged Loan Index, which returned 7.50% in the same period. This fund is actually performing quite well. It is keeping pace with its direct competitors. Now let's look at the realized gains and losses on investments. The Macquarie Corporate Bond Fund had a net realized loss of over $30 million for the year ended. The 31st of July 2025, that is a substantial loss, meaning they sold a lot of investments for less than they bought them for. And for the Macquarie Extended Duration Bond Fund, it is even worse. They had a realized loss of over $41 million. This tells us they were likely selling assets at a loss to meet redemptions, or because their strategies weren't working out as planned. Either way, these are big numbers representing real money loss for the funds. But on the flip side, let's look at the unrealized appreciation or depreciation on investments. The Macquarie Corporate Bond Fund actually saw an unrealized gain of over $24 million for the Macquarie Extended Duration Bond Fund. That unrealized gain was close to $26 million. This means that while they were selling some INV, sentiments at a loss, the value of the investments they still hold has gone up. This is why the total return can be different from the realized gains and losses. The market value of what they hold is still fluctuating, and in this case it is moving in the right direction for these two funds. Looking at the total net assets on the 31st of July 2025, the Macquarie Corporate Bond Fund had over $1 billion in net assets, and the Macquarie Extended Duration Bond Fund was about $295 million. This is the amount left after all liabilities are subtracted from assets, a key indicator of the size and financial health of the fund. And diving into the share classes, the net asset value per S-share for the Macquarie Corporate Bond Fund class A was $15.27 class C, was $15.27 class C, was $15.28 institutional class was $15.27, and class R6 was $15.26. So even though expenses differ, the actual value per S-share they represent is quite close in this fund. Let's look at the expense ratios for the Macquarie Corporate Bond Fund class. C shares the ratio of expenses to average net assets was 1.55%, and before any waivers it was 1.66%. This is a pretty high expense ratio for a bond fund. It means that for every $100 you invest over a year, you are paying over $1 and a half in fees. That is a significant chunk that gets eaten away from your returns year after year. Now let's talk about the big shift on the 21st of April 2025. It was announced that Nomura is set to acquire Macquarie Asset Management as US and European public investments business. This is a huge deal that is expected to close around November 2025. This acquisition means that the funds we've been looking at, Macquarie Corporate B, on D Fund and Macquarie Extended Duration Bond Fund, will be renamed Nomura Corporate Bond Fund and Nomura Extended Duration Bond Fund, respectively. This is a major change in ownership and management, and it is always something to watch closely. When a fund changes hands, what will the new management do differently? Will the strategy change? Will costs go up or down? These are the questions investors need to be asking. Finally, let us peek at what the Macquarie Corporate Bond Fund actually owns in the schedule of investments. We see a breakdown of their holdings. A significant chunk, around 23.64%, is in banking-related corporate bonds, followed by communications at 9.24% and capital goods at 8.67%. They also hold collateralized loan obligations amounting to 0.52% of the fund. Now, CLOs can be complex and their performance can be a bit unpredictable, especially when interest rates move around dramatically. It is interesting to see them holding these, especially in a corporate bond fund that might be considered more conservative by some investors. So what is the takeaway here? After sifting through these filings, we see a picture of mixed performance. Macquarie Corporate Bond Fund and Extended Duration Bond Fund seem to be facing headwinds with negative or subpar returns and high expense ratios. The floating rate fund, on the other hand, is looking a bit more promising, keeping pace with its benchmark. It is crucial to remember that past performance is never a guarantee of future results, especially with these types of fund. The upcoming acquisition by Nomura also adds a layer of uncertainty and potential change that investors should absolutely be aware of. What is your take on these funds? Could they be a good investment, or is it time to steer clear? Let me know your thoughts in the comments below if you found this breakdown useful. Give this video a thumbs up, it really helps the channel, and make sure you are subscribed so you don't miss our next deep dive into the corporate world, and if you want to connect with other finance enthusiasts and get even more exclusive content, join our Discord community, linked in the description below. Thanks for watching, and we'll see you on the next Corporate Decoder Control 63.